Why does gold consistently re-enter the financial discourse whenever inflation looms? This isn't merely a market anomaly. It's a deeply rooted phenomenon, echoing centuries of economic history and human behavior. Today, we embark on an analytical journey to understand gold's enduring relevance during inflationary periods, offering insights for investors, economists, and the curious mind alike. The question of gold's role during inflation is more than a casual observation. It's a critical inquiry into monetary stability and asset preservation. We aim to dissect this relationship, moving beyond simplistic narratives to explore its historical underpinnings, economic rationale, and market implications. This analysis provides a robust framework for understanding gold's position in a volatile economic landscape. This exploration is not about predicting future prices or offering investment advice. Instead, it's an academic and practical examination of gold's historical function. By understanding its past, we gain clarity on its perceived value and behavior in contemporary financial markets. Gold's connection to human civilization as a medium of exchange and store of value spans over 6,000 years. From ancient Lydian coins to the Byzantine solidus, and later as the bedrock of the international monetary system under the gold standard, its role has been foundational. This deep historical precedent imbues gold with a unique psychological and economic weight. Even after the formal abandonment of the gold standard, its historical significance did not vanish. This extensive monetary history shapes collective memory and investor perception, influencing how gold is viewed today, particularly when traditional fiat currencies face challenges. It's a legacy that transcends mere commodity status. Inflation, at its core, represents a decline in the purchasing power of a currency. It means that over time, the same amount of money buys fewer goods and services. This economic phenomenon is often driven by an increase in the money supply relative to the availability of goods or by demand pull and cost push factors. Gold enters this conversation because it exists largely outside the direct control of national monetary policies. Unlike fiat currencies, which can be expanded by central banks, gold's supply is finite and grows at a geologically constrained pace. This independence makes it a compelling reference point when evaluating the stability of conventional money. Historically, gold has functioned as a sensitive barometer for monetary conditions, rather than an active solution to inflation. When currencies experience significant devaluation, the nominal price of gold often rises. This increase primarily reflects the diminished value of the currency being used to measure gold, not an intrinsic change in gold itself. This crucial distinction is vital for a nuanced understanding. Gold does not cause inflation, nor does it inherently solve it. Instead, its price movements often serve as a clear indicator of underlying monetary instability and the erosion of purchasing power. Recognizing this helps to demystify gold's role and temper unrealistic expectations. History offers compelling evidence of gold's behavior during periods of monetary stress. During the hyperinflation of Weimar Germany, while direct gold transactions were limited, the concept of gold as a stable asset became paramount. In the United States during the 1970s, as inflation soared and the dollar decoupled from gold, its price surged dramatically. These historical episodes illustrate a recurring pattern. When confidence in fiat currencies wanes, gold often retains its purchasing power more effectively. This consistent behavior across different monetary regimes has cemented gold's reputation as a potential hedge against currency debasement and a store of value during economic uncertainty. While other precious metals like silver share some characteristics, gold's unique combination of traits elevates its status during inflationary discussions. Its extremely slow supply growth, dictated by geological scarcity and high extraction costs, contrasts sharply with the potential for rapid fiat currency expansion. This scarcity underpins its long-term value. Furthermore, gold's exceptional durability, resistance to corrosion, and universal recognition across cultures and economies contribute to its appeal. These enduring qualities, coupled with its unparalleled monetary history, make gold particularly well-suited as a long-term reference point and a perceived safe haven during periods of monetary flux. Inflation inherently breeds uncertainty and anxiety among investors and the general public. In such environments, Individuals often seek refuge in assets perceived as stable and historically reliable. Gold, with its millennia-long track record, offers a sense of familiarity and trust during turbulent times. This psychological dimension is critical. The collective memory of gold's historical performance, combined with its tangible nature, provides a sense of security that digital or paper assets may lack. This behavioral preference helps explain gold's consistent reemergence in conversations about preserving wealth during inflationary pressures. It is crucial to maintain a balanced and analytical perspective on gold. While it offers unique benefits, gold is not immune to market fluctuations and does not move in a straight line. Its price is influenced by a complex interplay of factors, including real interest rates, geopolitical events, and overall market sentiment, not solely inflation. For investors, gold can serve as a strategic portfolio diversifier, potentially offering a hedge against systemic risks and currency devaluation. However, it should be viewed as one component within a broader investment strategy, understood for its historical role and economic characteristics, rather than as a guaranteed solution or a speculative play. Gold's prominence in inflation discussions often extends to a broader consideration of the precious metals complex, including silver, platinum, and palladium. While each metal possesses distinct industrial and investment characteristics, gold's historical monetary role typically positions it as the primary focus. Its liquidity and universal acceptance make it the benchmark. Understanding gold's dynamics provides a foundational insight into the behavior of other precious metals during inflationary periods. While their individual supply-demand fundamentals vary, the overarching theme of tangible asset preservation against currency debasement often links them in the minds of investors and analysts. Gold's consistent discussion during inflationary periods is not arbitrary. It is a testament to its enduring role as a historical reference point for monetary value. It reflects, rather than dictates, the changing landscape of economic stability and currency strength. For investors, economists, and students of finance, understanding this relationship offers invaluable context. By viewing gold through this historical and analytical lens, we can interpret its relevance without succumbing to hype or misunderstanding. It stands as a tangible reminder of monetary principles that have guided economies for centuries, offering a unique perspective on the challenges of preserving wealth in an ever-evolving financial world. If this deep dive into gold's historical and economic significance during inflation has enriched your perspective, please consider sharing your thoughts. Your engagement fuels our mission to deliver insightful, analytical content. Actionable insight. Research the real interest rate environment in your country and how it correlates with gold prices over the last decade. This exercise can provide a practical understanding of gold's sensitivity to monetary policy. Thank you for joining us on this analytical journey. We hope you continue to explore the intricate world of finance with curiosity and critical thought. Asterisk. Disclaimer. This content is for educational and informational purposes only and does not constitute financial, investment, or professional advice. Always consult with a qualified financial advisor before making any investment decisions.